week on Make Better Wealth Decision, we're speaking with George Kailas, who is the CEO of Prospero.ai. He's a Wall Street expert on the use of artificial intelligence and applying it to make better wealth decisions. You won't want to miss this.
Make Better Wealth Decisions, a podcast that explores how financial advisors' blind spots can harm your investments. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto. In this podcast, we'll provide advice on how you can achieve better outcomes by maximizing investments and minimizing taxes. Let's put our thinking caps on as we consciously decide to get smarter about our money.
This week on Make Better Wealth Decisions, we're speaking with George Kailas. George is the CEO of Prospero.ai, and it is an app which is designed to democratize high-level investment strategies with AI, making them more accessible, more personalized, and effective for retail investors. George, how are you this morning?
I'm doing great. Interesting night last night, obviously, but it's nice to have a conclusion to the election that's refreshing from the last one.
It should be noted here that we're recording this on Wednesday morning, and so the day after the U.S. election. So it's fascinating to see how this will play out. And actually, I will probably have one or two questions related to the election for you. Prospero.ai. Perhaps you could take a moment to walk us through what it is you and your company do and why it's important.
Yeah, I think we're going to get into my history, but I've had a long history on Wall Street. I worked at my first hedge fund when I was 17. And I would say even when I was on the buy side as a small hedge fund, I felt very disadvantaged and there was information I didn't have access to. So the Prospero signals, the technology has really been built to look at what I would call underlying market equations and make it easier for retail investors to both understand and harness them. And yeah, not only do we have the app, but we actually have a few different newsletters, a trading and an investing letter. And the investing letter is free and it's actually beating the market by about 50% the last 2 years. And this year, about 67%. We have a lot of different ways to teach and access the information, but the goal is to just help retail investors better understand, I'd say, especially what institutions are doing so they can make better, more informed decisions.
Which is entirely in keeping with the mandate for this podcast, which is making better wealth decisions. And decision-making comes in many shapes and forms. And up until now, I really haven't explored the use of AI in decision-making. So I think it's past due that I have a conversation with someone like you. Let's begin by maybe talking about something that's a little off the beaten path, which is boycotts. Why are boycotts trouble? And why is that sort of brewing as being a trouble spot for investors?
I think it's very interesting what we're seeing in terms of social media becoming a bigger and bigger impact. And what I love to say about why we're positioning as we did, but I've seen these trends happening a long time. When I first worked on Wall Street, it used to be an impenetrable fortress. You'd call up your friends, you had a tip, you had some insight, you talked to a CEO, and really there was no way for retail to win in that game. But as hedge funds, institutions have become more dependent on social media data, and 70% of them use social media data, now that has actually really empowered retail investors in a lot of ways where things like boycotts are important. I talk about like this spiraling up and spiraling down that you see. And spiraling up would be in a situation like NVIDIA or Tesla, where people buy the products, it makes them more excited about them, more stock movements, more sales. You see an easier way to capitalize a company, and you get this spiraling up with social media. But the boycotts are the opposite, right? People start talking badly about a product online, the sales go down, then there's even worse conversations, and you can spiral the complete other direction. So I think in previous times where companies could really just focus on the fundamentals and just doing well as a company, we're in a world now where the fundamentals don't work if the internet turns on you, because then your sales are going to go down.
So much of investing is psychological. There's a guy by the name of Robert Shiller who won the Nobel Prize in 2013, who you may be familiar with. Shiller wrote a book called Narrative Economics, and he talks about how a lot of what happens in economies is, at least to some extent, psychologically self-fulfilling, because things happen because people expect them to happen. And once you buy into a narrative, it becomes the sort of thing that snowballs and continues. And I think that's what we're talking about here with boycotts, is that they can both move things up and down because of social media and public awareness becoming more and more of a thing. So let's take that and use that as a springboard to talk about things like Roaring Kitty and GameStop. What have they done? Again, because AI can actually play a role in both directions. So perhaps you can offer your thoughts on that.
So we have some very interesting touch points on this story. One of the things that I just think was amazing about what Roaring Kitty did and the original GameStop issue, which is just that it was a little too easy for short sellers to start shorting something, tank it in the media, and just push a story and push companies out of business. Whether or not they deserve to, I do think there's some efficient market stuff there. But certainly, I think some of the tactics where short sellers would go on and basically push their narrative and push these bankruptcies faster, I think it's something that it was great to see retail fight back
Mhm.
against. However, I was actually involved in AMC pretty early. And part of it is I was building the social sentiment rating that is now on Prospero, and I was on the ground level doing that. And I basically said, and I think this is always good advice to anyone if you're thinking about a momentum play or a meme stock. I am always reliant on multi-legged investment theses, right? So when I got into AMC, I said, this one looks like it could be the next one from a social sentiment standpoint. But also, I think when the pandemic recedes, the sales are going to go up for AMC. So even if I don't get my short squeeze, what I do expect to get is a revenue recovery. So I had two legs to that. But what I saw is truly horrifying from there because what people and I told a lot of people in the AMC trade, that was the one I was most embedded in, but in everything, I told them it's just that if there's one rule on Wall Street, and this goes for hedge funds, retail, everybody, but especially retail, it's that you can't call plays from the same playbook over and over again. And that is just as true for the largest hedge funds as it is for retail. People are going to figure out what they're doing. They're going to figure out how to punish you for doing the same strategy over and over again, regardless of the strategy. So what has happened in meme stocks since then is the opposite of what it started at. It started as retail investors smartly sneaking up on institutions through Roaring Kitty on aggressive short selling. And now what it is sadly turned into is institutions manipulating retail investors for profit. I've seen it time and time again. They'll short these stocks. They know they have retail attention. They'll be buying call options, by the way, as the short goes down. Then they'll attract the attention. They'll use bots on things like Reddit to overhype it. And then they'll make money on the way up. And they'll make even more money on the quote unquote rug pull as they start cashing in on those calls, buying puts, because they know it's going to end eventually because these aren't value driven trades. And the last thing that was very important, there's a really cool case study, one of my favorites of Prospero in this latest run from Roaring Kitty, where he started posting. And we actually saw our net option sentiment. And I think we're going to get into AI later. But one of the things that really differentiates us is because of my history as a value investor. And I worked at Columbia Business School for Bruce Greenwald in the Value Investing Center before I taught myself accounting to work at my first value fund. So that's my roots. And a lot of that has come into the common sense AI that we use. And that's one of the things, really, the things that we focus on is institutional options pricing and how that reflects the overall demand on the call and put side for basically bets above where the stock is trading versus bets that it's going to go down. And we do a lot of cool things to make that easier to read because I always say this, options are not for everyone, but
Right.
understanding what's going on in the options markets is for everyone. And that is something that you want to be able to do.
I wanted to see if I could go a little bit off the beaten path to ask you about something that absolutely hit me as I was listening to you speak. There was a paper that came out about 2 months ago called The Less Efficient Market Hypothesis by Cliff Asness. Are you familiar with the paper?
I'm not.
Oh, okay. So let me take a moment to explain to you what Cliff's thesis is. And then I'd love to get your take on this because I think it's entirely in keeping with what you're talking about. So Cliff is a quant manager. He's managing a multi-billion dollar fund called AQR. He is a disciple of Gene Fama's at Chicago. So he was the sort of person who would have spent his entire career talking about markets being more or less efficient, but he believes that there are certain things which would not be called mispricings, but rather factors that you can tilt toward in terms of getting more exposure to these things and getting a better risk return trade-off. And that's a lot of what he does in his quant shop. He came out with a paper 2 months ago, give or take, I'm going to say in the early autumn, where he said, in my opinion, and there's just like the efficient market hypothesis itself, it's very difficult to test, and therefore it's difficult to unequivocally prove, and it's very difficult to unequivocally refute. It's a hypothesis that seems to explain things, but we'll see. And his hypothesis is that over the past 25, maybe 30 years, markets have actually become less efficient because everyone assumes they become more efficient over time as people become more sophisticated. They become less efficient because of the AMCs and the GameStops and the democratization of people who are going in and doing precisely the things you're talking about, which is making decisions which are maybe less based on metrics, numbers, valuations, and more based on mood, sentiment, the way trends are going and so forth. And as a result of that, it's difficult to get the price of any given security is less likely to be more or less right in 2024 than it was in, say, 1994. And that if there's going to be a mispricing, it's likely to be greater. It's more likely to happen. It's more likely to be more severe relative to the extent to which we could notionally think things are inappropriate. And as a result of that, bubbles can form, and they can form more readily, and they can persist for longer. Here we are in November of 2024 with the US stock market trading at, I don't know, 36 times the cyclically adjusted price earnings ratio, referencing Schiller once again, and at very high valuations. What is your take on what's being put forward here by Cliff Asness? Do you think markets have actually become less efficient and therefore maybe a little bit riskier?
Oh, I think they absolutely have. And I think a lot of it is these social momentum plays where, because you can get a feel for where retail is going and you can move them. And I refer to that as like social physics. And I do think it makes it more efficient because a lot of what Prospero focuses on, and like our best case study, is Meta. And a lot of what we focus on is this idea that even technicals don't necessarily work that well in cases in these new markets. Technicals, whether they be on momentum or valuation. And the really good example is we first got into Meta when it was trading at 170 and it was 100 in our upside breakout, which looks at long-term options, especially on the call side, demand, price targets, analyst ratings, price momentum factors, all smashed together and scaled. So basically you have to have that at 100. We had that at 100, and all of those things have to do well, right? So one of the things that we kept seeing, and Meta's been a favorite of ours for a while. We actually just dropped it for some longer reasons. But basically what we saw is my first lesson in value investing, which was my boss told me his biggest profit was in a garbage company, and you could always look for the garbage. And the garbage in the case of Meta was that Mark Zuckerberg had misspent in the metaverse. He wasn't really that well liked. So a lot of institutional options bettors, I would say, especially, were ahead of the curve on this. But we kept on seeing it at the top at 100. So price targets kept on getting raised as it went out. And I think eventually the market caught up, right? But I think that's a really good example of an inefficiency that was on such a big company, right? Meta was obviously a huge market cap. To have that big of an inefficiency, not that much has changed over time in terms of the story, the profitability. Like even at that time, it was still one of the, I believe it was the fourth best kind of average growth of the Mag 7, right? Profitable company. What changed? The perception amount around Mark Zuckerberg. And I think that is a perfect example of even how a mega cap can be mispriced based around social sentiment. So I completely agree with that. And I think that not only does that create fundamental kind of mispricings in traditional kind of technicals, right? Because a lot of people said along the way as we liked it that it was overbought, right? But it kept on going up. But I think you also have this detachment where there's value in momentum, and that can basically create, I would say, a complete detachment from fundamentals, right? You look at even just the Mag 7 at various times, right? You've seen Tesla at a 60 forward PE, and you've
Right.
seen Meta or Google at 20, right? That shouldn't happen in an efficient market, right? You could argue that there'd be some detachment there, but I think when you start seeing things like this and you see that persist, even when Tesla started to post some bad quarters, right? I think that right there is evidence just in the mega caps. And the mega caps are where you would expect the most efficient
Right.
pricing.
Right. Exactly. So it sounds almost as though AI is allowing you to be the new Wolf of Wall Street, but in a good way. Can you
Yes, I
comment?
think. Yeah, I don't know if I love being like associated with that. I will associate from that in the sense that he did reach out to a lot of like smaller investors and try to really like
Yes.
bring them in and bring them for at least a little bit interesting ideas and money. But yes, I think we're trying to do things in a very new way. We're trying to do things in a populist way, but I think we're really the first place and only place that is trying to bring transparency. And
Good.
that's our strategy, right?
Okay.
And I
So
think it's a great strategy.
sure, of course. What about economic forecasting? What would you say is the role of AI with regard to economic forecasting? Because believe me, I'm always reading things. And what's the joke that the one president used to say? What I need is a one-handed economist, because they're always saying on the other hand. So, what's your thinking on AI and forecasting?
I don't think we've seen the tech get there in terms of where I would want it to be. And we're always running model simulations. The way that we actually forecast our profitability and our growth is we take analyst ratings, some general macro assumptions from different sources, and we'll simulate around that. So we're not oversampling on any given data point. We've started to actually validate analysts based on how successful they are and start to weigh that more. But I don't think I don't think we're really there. And I'll tell you something about forecasting in general. That's funny. In my 13 years in AI, probably the worst we ever did, and a journey to where we are today. And we experimented with models as complex as evolving neural networks, joint IP with NYU. The worst we've done is trying to forecast stocks.
Okay.
What we've actually done very well is starting to look at things like using AI to identify institutional trades, identify specific things like that, what the difference between a good and a bad analyst is, running intelligent simulations that grade themselves and self-improve in terms of how we're forecasting that kind of thing. But the second you start trying to say things like, obviously the hardest thing, what's the non-farm payroll going to be?
Right.
Like, that's when you start to get terrible results. And maybe I'm giving away a little too much to my competitors, but we have a lot of experience doing this, so they
Okay.
can try to catch up on that. But yes, I think the more specific you try to predict a number versus versus analyze behavior and use that behavior to make inferences on top of, right? When we write our newsletter, the performance I listed is actually still me taking all these advanced metrics and putting together a thesis around that. One of the things that we look at, for example, is the difference between things like growth and profitability forecasts among cohorts of stocks, right? We'll look
Right.
at, say, like profitability stocks with our profitability rating above 80 and like where the growth is to basically say, okay, where are mega caps growing in our projections relative to small caps? And that's one of the things that we've done very well this year because we've continued, as people say, oh, the breadth is coming, the breadth is coming, the breadth is coming. We've actually been just buying mega caps all year and saying we have no reason to believe that this is slowing down. Cheater between us, like we want to make sure that we have good data science at our core that is explaining exactly what we want it to explain instead of trying to take that too far and make a stock prediction, make an economic
Okay.
forecast, because that doesn't work. And I like outside of the largest hedge funds where I have seen successful models on that and heard about them at least with like billions more than we have to spend on this problem. I haven't heard about it working, but that is also inherent in our strategy why we focus on where they're making their options bets, because we're basically piggybacking on their ability to do that better than us.
Okay, so I'm a bit of an AI Luddite, and I freely confess it. And part of it is just my age, and part of it is just my historical allergy to technology. And I try to be as forward-looking as I can, but I can only do so much. What would you say are the trends that we should be watching for in AI in the next year or two? I don't know how far ahead you can look, but what's coming down the pike?
So I already see it. I don't know if you're talking about like from a corporate perspective or from an analysis, but I'll
What do you
give
think
you
about?
both. Like
Yeah.
one of the things, one of the things that I warn against are these silver bullet AI companies, and there's going to be a lot more where they're coming and saying, "Oh, we'll invest your money. We could beat the market." Blah blah blah. And I basically saw those come and go in the last bear market. But there's going to be more and more. A lot of them are getting funded. Be very careful about that.
Right.
What I like to say is that use some common sense always, right? If these companies haven't even raised $100 million and Bridgewater could lose that in a day and not bat an eye, how are you going to convince yourself that place is competing with Bridgewater? There's more tax efficient than Vanguard, which is what I see with some of these. It's just use common sense on that stuff. And that's why I like try to have the common sense example of why we leverage institutional options trades and visualizing around that. So I think that's the first thing that people should be very careful about because that is pretty unregulated right now and a dangerous way that you could lose your money, especially in a volatile market. And you're just better off avoiding silver bullets in any kind of investing. The second thing is in terms of what's happening with AI, I have some do's and don'ts for people, right?
Okay.
Actually, in terms of chips, I've been very bullish on chips for a while and they've posted great numbers. I would be a little apprehensive right now with this election in terms of NVIDIA. I think Broadcom, I think is the safest. If you want something that's done and you want chips exposure, I do like them. There was that OpenAI announcement. If you want chips, I would say Broadcom is probably the safest thing, but there might be some chip wars coming with China and these tariffs. So I'd be a little careful there. I'm going to give my boring answer for AI, and then I'll give you some more interesting stuff. My boring answer on AI is just bet the cloud providers, Amazon, Microsoft, Google, right? And how I describe them is I think actually the highest upside is Microsoft. And you have even things where they're doing interesting things with GitHub and Copilot, in addition to they're doing very interesting high upside things. The safest bet is going to be Amazon. The biggest problem with Amazon always is that it's overpriced, like relative to the other
Precisely
ones,
for the
but it's
reason you gave.
overpriced because it's the most stable one. Hold it for
Right.
10 years, you'll be happy. But I also wouldn't count out Google, and it's cheap relative to Microsoft. But I think if you buy those three, you're going to be very happy about what happens because I think a lot of like services, right? Even if you look at a place like Palantir, I worry about how Palantir is going to compete with a Google or an Amazon or a Microsoft as they start to get more into those like consulting type businesses long term. You obviously have them looking at making their own chips with another worry about chips. So a lot of these, you're wondering if you want a more interesting AI play, I like IonQ, quantum
Okay.
computing, and or something like CCJ, nuclear energy, right? Those quantum computing, nuclear energy, I think if you want like the bigger upside, there's more risk that comes to that. If you want something more interesting, my official advice to you is buy the cloud providers, hold on to them. You're going to be happy. But if you want some more upside, I wouldn't go small chip maker. I would go quantum computing, nuclear.
We don't have time for the don'ts. We have to wrap this up, George. So let's see if we can end with
The
the question.
don'ts. Stay away. Don't be so aggressive with the. Be careful with the chips. Were the don'ts.
Okay, good. Make better wealth decisions. What advice would you give people to help them make better wealth decisions?
So I think in addition to using tools like Prospero, understanding the flow, I would say, especially in the options markets, very important. Yet also having just like a wealth of sources. What I always tell the people, learn to read primary sources. There's so many retail investors that will come to me. And then when I was in AMC, they're like, what happened here? And I'm just like, I read this on Reddit and I'm just like, here's the document, here's the filing, you could read it. It's only 3 pages long. So learn how to read primary sources. That's the important thing. The other thing is I was just quoted a lot on something that made me look very smart, which was to Trump voters, I was like, if you're going to play a stock, play Tesla, play Coinbase, do not play DJT. And since I wrote a newsletter a few weeks ago, DJT is down over 10%. Tesla's up about 5%, and coin is up about 12%. And what I just basically said, I was like, look at enterprise value to sales, right? DJT was at 1,600, Tesla was at 8, and Coinbase was at 7, right? I was like, you could do well with all of these stocks if Trump wins. And I'm not saying DJT couldn't potentially make more if he does, but the risk reward is going to be much better if you look at your base level value. So look at EV to sales, look at things like forward PE ratios relative to other companies, relative to companies in the sector. Make that a part of even your social sentiment analysis, and you're going to do way better.
Great. George, thank you so much. This has been a fascinating conversation. I want to wish you all the best.
Thanks. Thanks for having me on.
John DeGooey is a portfolio manager with Design Securities in Toronto. The views expressed in this program are not to be construed as specific advice. It is recommended that you consult a qualified advisor before taking action. His books, The Professional Financial Advisor 4, Stand Up to the Financial Services Industry, and Bullshift are available through Amazon and in bookstores throughout Canada. You can reach John at 647-STAND-UP. That's 647-782-6387 or at jdegooey@designedsecurities.ca.